Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Rufus Rankin, director and head of Empirical Index Research at Nasdaq, to discuss how option strategy indexes linked to the Nasdaq-100 Index can be used for various portfolio goals. Rufus, it's great to have you with us. Welcome to Trade Talks.
Thank you so much. It's great to be here.
You got it. An article written by the index research team has been accepted for publication in the Journal of Beta Investment Strategies, a peer-reviewed academic journal. Give us an overview.
Right. So what we did with this article was look at how option strategy indexes linked to the Nasdaq-100 index can be used for various portfolio goals. And one of the reasons we did this research was to see if options could perform some or all of the roles traditionally assigned to bonds.
And Rufus, let's go through a couple of the strategies here. The first one, increasing distribution yield in income portfolios.
Right. So looking at this, this first slide is actually a bit of background, just looking at the long-run correlation between stocks and bonds. We can see that over the last 20 or so years, the rolling 12-month correlation between stocks and bonds has often been strongly positive. And we go into further detail in the paper and show that when you look at when stocks are rising, that correlation is often negative. But when you look at when stocks are falling, unfortunately, that correlation often goes flat or even slightly positive. So that traditional role of bonds serving as a hedge for equities may not hold out in the future.
Right, and perfect segue. Let's pull up that next chart with our first strategy here that talks about income.
Absolutely. So what we did here was we looked at BXNT, and that's the SIBO Nasdaq-100 Buy Right Index. It tracks a covered call strategy on the Nasdaq-100 Index. And what we found was that adding this index to a stock and bond portfolio can dramatically increase distribution yield. So in this historical sample, we were able to add nearly 3% annual distribution yield while increasing volatility less than 1%. Now, given the rate environment we've been in for the last decade, that actually more than doubled the distribution yield of a portfolio already focused on generating income. So very powerful result without adding any additional risk.
And let's talk about our next strategy here, where you're looking to boost return while reducing risk in growth portfolios, which certainly is clearly something investors are looking for in this market.
Indeed. So in this example, we're looking at NQTRI. That's the Nasdaq-100 Quarterly Protective Put Index. That's an index that tracks a strategy that's long the Nasdaq-100, but also buys puts for a little bit of downside protection as well. And what we can see here is we've charted NQTRI versus the Nasdaq-100 index. And in that circle, you can see that the index has kind of put a floor on or cut off the worst negative returns of the Nasdaq-100 index. So we looked at adding this to stock bond portfolios and found that we could increase return, reduce volatility, and cut the maximum drawdown experienced by stock bond portfolios by a healthy amount. Then we also went into a nice simulation study to look at the distribution of outcomes, generating a lot of different portfolios or alternative histories, if you will, and found that across the board, including this index or strategy, had a very positive effect on reducing risk, but also increasing the terminal wealth of the portfolio.
And finally, Rufus, let's wrap with optimal portfolios that leverage options.
Right, absolutely. So what we did here was we fed our suite of option strategy indexes and a stock proxy and a bond proxy into a mean variance optimizer. And what we found was that pretty much for any target risk an investor might have, target risk level an investor might have, there is a place for an option strategy in that portfolio to make it better. So a mean variance optimizer is simply looking for, given a certain level of risk that we're trying to target, how can we maximize return for each unit of risk? And so what we found here is that as we go from left to right, from portfolios with very low targeted targets of annualized volatility, say 3.25%, to very high portfolio volatility, targeting more than 17%, at least one, and in many cases, two of our option strategy indexes are included. So what that tells us is that in almost any kind of portfolio you'd want to have, including one or more of these option strategy indexes can improve that portfolio, which we thought was a very powerful result and very helpful.
All right, Rufus, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much.